So good afternoon, everyone, and thank you so much for joining us today. My name is Beatrice Magister, and I'm a postdoctoral fellow here at SRI. Today, I'm pleased to introduce to you Michelle Alexopoulos. She's a professor of economics at the University of Toronto with a cross appointment to the Faculty of Information. She's currently the Deputy Vice President of the Canadian Economics Association, a fellow of the Bank of Canada, a Canadian Productivity Partnership collaborator, and a faculty affiliate of the SRI. She is a macroeconomist whose research focuses on business cycles, monetary policy, technical change, economic uncertainty, labor markets, and productivity. Her research, supported by numerous public and private grants, has been published in top-tier economics journals and has been presented in numerous central banks and conferences. The title of her talk today is "It's Not Just What They Say, but How They Say It, Using AI to Understand the Impact of Policy Statements on Markets." So we're very grateful for her presence with us today. And without further ado, please join me in welcoming Michelle.
Thank you very much, Beatrice. So let me just share my screen. And hopefully everyone should be able to see it now. Yes? Okay, perfect. So thank you very much for that lovely introduction. As I said, or as was just said, we're going to talk a little bit about how a project that I'm doing with my fellow colleagues at the Bank of Canada is using AI and natural language processing in order to try to understand the impact of policy statements on markets. So this is based on a project with Jinfen, Alexi, and Sue. They're all actually here today. So when we get to the question and answer period, there'll be a panel of us who are going to be able to answer questions, hopefully for you. And as I have to sort of say, because this is in conjunction with the Bank of Canada, the views expressed are solely those of the researchers here and do not necessarily reflect the official views of the Bank of Canada. So because this is a cross-disciplinary group, I want to do a quick overview where I'm going to start with a general discussion just about the importance of policy communication. So why do we want to take a look at policy communications and throw a bunch of AI tools at it? I'd like to talk a little bit about how monetary policy communications then are thought to impact agents. I'll then talk about measuring the aspects of the communication inside our particular project and how we apply the various tools, and our testing to see if and how the words chosen, the body language, and the tone of voice actually impact, if they do, the S&P 500 and the VIX, which is often known to be it's a measure, obviously, of volatility, and some people consider it to be a measure of fear in markets. So let's just start quickly with a discussion about the importance of communication. So importance of policy communication, I think it's fairly clear to most individuals that economic policies that are enacted either by the government or the government agencies like the Bank of Canada are going to have very large impacts on the welfare of businesses and individuals, right? They are often very complex. They have a lot of nuances that come along with the different policies. And really, for us to achieve the desired results, if you're a policymaker, you are required to have both effective and accurate communication of the details and any changes to these policies that may be coming down the road. Now, when we think about monetary policy in particular, often what we'd see is things like the interest rate decisions and forward guidance. Two of these things are used in conjunction to explain to market participants and to households what it is that the Bank of Canada is actually thinking and what kind of actions they're going to be taking. Now, how does it affect the outcomes? Well, really, the way that monetary policy generally works is we have these objectives of the central bank. This would be true for the Bank of Canada. It's true for the Federal Reserve. And they get a bunch of macroeconomic data in that tells us how the economy is doing, and they have a strategy, right? This strategy is going to help inform what kind of policy decisions they have. So the Federal Reserve has a dual mandate. So it's watching quite closely what's going on with both unemployment or the employment and our inflation rates. Here in Canada, we're considered to be flexible inflation targeters, but we often are paying attention to the general economic behavior. Now, when they take these decisions, right, they're going to be making statements about the forward guidance, like I'm going to promise to keep rates low for a certain amount of time, or statements that are going to say, I'm going to hold rates low until I see particular strength in various markets. And I'm going to be making announcements on interest rates and the types of transactions that I'm going to do. Now, this is then communicated, obviously, to the public. And here we're going to have two forms of communication, right? There's a direct form of communication, which is where we go and get the information directly from the central bank. And then we have an indirect form of communication, where it's somebody else reporting to us what the central bank is doing or has done. And that's what ends up managing our expectations, okay, and informing what it is we think we should be doing or how the economy is actually unfolding. And then the markets and the economic agents are actually going to act on that information. Now, as usual, it's never as simple as it seems, right? The perception of the communication is really important to understanding what kind of actions end up coming out, right? And so I think this is really clear. Perception matters, and things then that are going to affect your perception are going to potentially have real economic outcome effects. Now, when we think about or talk to individuals in the media departments at central banks, they're going to tell you that there's a bunch of challenges that they face in terms of direct communications, getting the information from point A to point B. Now, the first one that's going to come up is going to be inattention. So for example, we're talking here today, it's January the 26th. I don't know how many of you know, some of you, there were some economists I saw in the room, how many of you knew that the Federal Reserve actually released a statement today, that they had an announcement, they made an interest rate decision, and they're holding a press conference as we speak. Right? So did you watch it? If you didn't watch it, who watched it? Right? So this ends up being very important in doing this. So I see that Sheila has her hand up. Should I deal with that question? Okay. I don't know.
I didn't see that.
I saw a hand pop up. Maybe it just went back down.
I think she was saying, I heard the announcement.
Oh, she heard the announcement. Okay, perfect. So it wasn't just the Fed. It was also the Bank of Canada. The Bank of Canada moved this morning. The Federal Reserve is doing this as we had now. So Sheila heard about it. Whether she directly watched it or not, I don't know. But when you actually are thinking about then the challenges, we also need clarity. Right. So if you did know and you did look at it or you did watch it, did you understand what was being conveyed to you? Did you find that the statements that were being made and how they were delivered credible? Okay. And then there's the consistency of the message. If you have multiple forms of the communication going on at once, are all of those working in the same direction, or is there something in there that causes you to be a little uncertain about what was meant? Uncertainty in an economic standpoint is usually something that has detrimental effects. You don't end up getting the same impact as you hoped you were going to get. Now, if we go to the indirect communication, that becomes even more complex, right? It usually reaches a much larger audience. This is media reporting of events. This is news wires. This is the follow-on analyst viewpoint, okay? But there's inattention there too, right? Did the media reach the proper targeted or necessary audiences in there? When you actually have the journalists watching and then reporting, did they correctly interpret what was being conveyed to them? And then when they turned around and wrote it and distribute it to everybody else, did they actually clearly convey what was supposed to be conveyed to the public? Then on top of that, we have issues of biases and non-neutrality that can come into play. And the sentiment that the journalists may have interpreted is what ends up getting echoed, all right? And then of course, there's not everything is going to be covered, right? What was excluded and what ended up being included. So direct communications, just to give you an idea. So you could have a federal open market press release. This is an older one because it wasn't available for me, the new one when I did the slides. But what you'll see is there's a lot of technical information inside this. I'm just giving like a small piece of this. What you're going to basically see is statements by the Fed telling you what it is that they're sort of committing to. You're generally going to see statements that are going to tell you how good or bad the economy is doing and what kind of risks are there. And then they're going to give some details about the policy statement. So I'm not going to read the entire thing to you, but you can clearly see that individuals' interpretation of what's going to go on, or even some of the forward guidance, can be a little bit murky at times. Now, on top of that kind of direct text that we actually have, we have examples of direct communication that basically go beyond. And the two most common examples of this, besides sort of speeches that happen by, say, Fed presidents is the FOMC press conference. As I said, we've got one of those going on as we speak. And we have testimony that's given in front of the Senate and in front of the House in the United States. Okay. In terms of the indirect communication, what we can get is we can then get the commentary that goes on with things like CNBC. We can get Fox News coverage. It could be live, as you see on some of these statements here, or it could be the next day. So I have another one here, which is showing you the markets closed with 4-day winning streak after Yellen's testimony. And I've got some of the closed captioning there. They were actually talking about the recap of what she was saying and how they believed or disbelieved what it was that she actually said. It's also usually blasted out on tweets, and it shows up in our newspapers either later on in the day or the next day. Now, when we think about communication, and this is where, having to use the AI tools and everything really comes into play, is there's different elements of communication. So perhaps you've heard the statement that over 90% of communication comes from body language and tone of voice. So hopefully I'm conveying I'm fairly relaxed right now. I'm happy to be here with all of you. Now, this actually comes, these numbers that sort of usually get blasted out in the media, comes from a book, Silent Messages, that was published in 1971. It's actually based on some psychological experiments in the 1960s. It had to do with salesmen. It was a small sample, but basically by repeating words in particular ways, most of the people who were receiving the messages reported that it was the tone of their voice and the body language itself that made a difference to how the message was being interpreted. Now, the actual magnitudes, I'm not going to stand on those. I think the jury's out on exactly what the magnitudes are, but I think the idea of that communication goes beyond text is basically valid. And we have a lot of individuals who try to teach us how to be effective communicators. And part of that's, how do I stand? Do I look like I'm, folding my arms, looking angry, or whether or not I'm looking relaxed and confident in what I do? Okay, so examples for soft communications here at the Fed, I just took a couple of random shots from a couple of the policy things. And you can see on the one side, we have Janet Yellen. I'll leave it up to you to decide which one of those she looks more relaxed in and which one she looks a little bit more displeased. And Ben Bernanke, which one he looks more relaxed and perhaps displeased in these particular environments. But if you're being bombarded with certain types of visual cues, the psychology literature would say you may start internalizing this and react to it. And that's what we're sort of after taking a look at. So when might the body language and tone of voice actually matter? So there's some hypothetical reasons you might say, well, why do we care here? Well, we could have traders, since we're going to be looking at markets, whether they be the institutional traders or whether they be the retail traders. They could directly watch the communication. Okay, so our direct communication, and either they're looking for signals themselves that could affect their trades. So they're actively looking for information they could trade on that goes beyond the words. But the signals could also impact you a little bit less directly, right? It could affect your sentiment or the confidence, which would then potentially affect what their trading behavior is going forward. And you can see, you say, well, does anybody actually ever watch this stuff? This is just an example I had pulled at one point from YouTube, where we had a day trader who was just streaming everything they were watching. And I pulled a bunch of these on days of the testimony. And what you can see is the gentleman there's in the background. He's got a bunch of chat going on here, and they are actively watching the testimony on the screen of Jay Powell and making comments as they go along and doing their trading in the background. Now, the media is also the other way that things get blasted out, and some of the complementary research that I'll talk about in just a moment also seems to suggest that some of these effects get larger, perhaps over time. Okay, and why could that be? Well, it could be that the media that's going to be reporting on the event actually is going to be influencing the message and the coverage of the event, and therefore impact behavior, either consciously, again, or subconsciously. So just to give you an idea, is it that people are picking up on this? Well, CNBC and the Baltimore Sun, there's a couple of examples we'll give here. So here at the Baltimore Sun, after a testimony, they were talking about how Ben Bernanke answered tough questions with confidence, authority, and gentle smiles, right? When we actually looked at things for Janet Yellen, right after she became Fed chair, there was a very large discussion on CNBC talking about exactly her body language and what you might have learned from it. And they were commenting on, for example, At some time, she had her arms crossed, her eyebrows going up, and they were figuring this had more to do with expressing some insecurity at this particular time. And that there was a difference between when she was talking about monetary policy and the financial regulatory policy. Testimonies last for about 3 hours and cover many, many different topics. They then compared her and her cadence and her tone to Ben Bernanke, who was the previous Fed chair. And they were talking about his voice becoming shaky sometimes at times, whereas her cadence was pretty much consistent through the testimony that she had given. They said she was boom. I guess they really liked her particular testimony at that particular time. Now, when we actually do the little bit of extra evidence that we might have in terms of surveys that had been done, there was one that was more recently done by Dietrich and Woolman that were talking to German traders and people at banks who were analysts, and they were asking them whether or not they actually were influenced by the media, et cetera, that they were watching. And about half of them did say often to very, very often to always, they actually were impacted on what was going on. And then when they started asking them even about gut responses to these things, they found that 90% of the people had admitted to making trades based on sort of gut influences, and that their importance of their gut feelings were actually important to them in making decisions. Now, of course, there's the other possibility that's not the individuals doing this. There's also the algorithmic trading that's going on right now as well. And it is possible that they're sucking in this type of information and trading on the behavior itself. We're not going to take a stand in what we're doing right now about where the impact is coming from. It could come from any of these particular channels. What we're interested in is whether or not we can use certain tools and what we can learn from these tools about the signals being sent and about a potential impact then on the outcomes in the market. So there's a bunch of literature that we're related to. We can talk more detail about that later, but really there's sort of high frequency financial data and event kind of studies to try to see whether or not monetary policy has an impact on markets. There's other work that's been done more related to sort of a text analysis on different types of Federal Reserve, ECB type communications. That's the Fracoli et al. We're also related to the emotion studies that have been done more recently in political science, which is looking at the impassioned pleas of politicians on the floors of the Senate or before the Supreme Court in the United States. And then there's some recent work that was looking really at the press conferences for the FOMC. One of these, the Gornichenko et al., is listening to the tone of the voice, and Courtney and Kresnik are watching a facial expression at intervals at about a minute apiece. Okay. Now, our research is going to differ a little bit from the other, and so I'm going to sort of highlight where that's what's true and where things sort of come together. So ours is going to differ in a number of dimensions. The first is we're going to use the Fed chair testimony, okay? And I'll explain why in just a few minutes. But for right now, this is still a work in progress. We're going to do 32 testimonies that are covering the period of 2010 to 2017. This is going to examine not just voice or just face or just text. We're going to use all of these together in order to get a more well-rounded idea of what forms of communications might matter. We're going to examine responses to both prepared statements, okay, which are the ones that the media people have really tried to train you to deliver in these particular environments, and the Q&A period, which is a back and forth. We're also going to be looking at both what's going on with the Federal Reserve Chair. And because we have the testimony from the senators and the congressional representatives, we can also look at whether or not their emotional responses are going to be impacting markets as well. So you might ask me, why on earth do we focus on testimonies? Okay, well, one of the things is they don't occur on the same day as a policy announcement. So right now, I just told you there was an interest rate announcement. They released a bunch of statements. Then we're going to have a press conference about the policy rate. So there's actually an action that's being taken at the same time the communication is going on. So instead, we decided we wanted to look at the testimony because we don't have that kind of blended environment where we have the interest rate movements happening on the same day as what the discussion is. All right. Now, this is just an example from the Bloomberg economic calendar. The number of the bulls that are shaded in is telling you how important they think this type of information is going to be. On the one side, you see the FOMC statements, the decisions, the press conferences. On the other side, Powell testifying on the 2 days is actually also ranked of the same type of importance as potentials to move markets. Now, they are also followed, or we have some evidence that does suggest they are followed by Fed watchers and investors. There's a recent survey, or not, I guess there was a 2016, there's been a couple of them from Olson and Wessel that suggested that there are a number of people, especially traders, who are watching these things actively. It doesn't have to be 100% for there to be impact, but it's a non-trivial component of these. Of the traders, only 29% said there was no real information in there that was of use to them, but a significant portion of them actually did say that they were getting something from these particular testimonies. Now, in addition to the small sample surveys, we also know that these are carried live, generally by C-SPAN and by the House or the Senate channels when this is occurring. And if you actually look at major outlets like CNBC, Fox Business News, Bloomberg, whether it be on the trading, on the satellite, or on their trading terminals, these are testimonies and times that can be actually watched and are usually watched by a number of the participants. So we have a large potential viewing audience. So if we have people watching, we should be able to test whether or not the different forms of communication actually have an impact. Okay. Now, it's not just the direct communication, the indirect communication also then plays a large point. So what we did is we also took a look at all of the news media coverage on Factiva in English, and we compared testimony dates to press conference dates, and we normalized by the number of articles that were coming out in here. And you can see this big swing. A couple days before the lower part, we've shaded it where these events are actually occurring and just putting things together. You see 2 days before, there's this large climb up in anticipation of the event. You have the event, and then for 2 days after, at least, they're echoing the announcements that are coming in. So the amounts for the testimony actually look like they're occupying even more of the newspaper coverage than what you would normally get from a press conference directly. It's also echoed on social media. So my colleague Jinfen looked at this on tweets related to the testimony. And again, you see the same kind of pattern of coverage going up and going down around the testimony dates. The other reasons are also fairly straightforward. One of the things, although we're only looking at 32 of them now, we have a whole bunch more being cleaned. We have a much longer time series that we can cover that will go back into Greenspan's era as well. And so this extends the time period under investigation. We can go forward and backwards. We have access and have been given access to high quality video data that's archived that is going to let us use measures and extract measures of emotions and the tone of voice. We have transcripts of proceedings that we have that were done at the same time. So these aren't necessarily the corrected ones, but these are the ones that were taken at the time of the actual testimony. And there's also a lot of evidence that my colleague Shu had pulled out on trades that suggest that the trading behavior on testimony days is in fact significantly higher than the trading days on a normal day, where a normal day would be the same month, but either a week before or a week after. Looking at that, we do see elevated trades during this time period. So let me give you a little bit of information on the properties of the testimony. Then we'll go into how we have to feed all of this into the AI and merge everything back together. So generally, the testimonies that we're going to look at right now are the semi-annual reports. There are 2 a year. They're often around February and July in here. For each of the report, the testimony is going to occur for 1 Senate committee and 1 House committee. Testimonies are about 2 to 3 hours long. And typically, and this is going to be useful in terms of identification or a different identification strategy, they're going to use the same remarks, written remarks, between day 1 and day 2. So we're going to have significant differences in the Q&A part, but we have similar time periods for the remarks themselves. So what usually happens is the statement itself is released before they actually start, or at the very beginning of the testimony. Okay, so here I'm giving an example of 10 o'clock. Lots of them do start at 10 o'clock in the morning. Then what happens is the text actually would get analyzed, and you can actually see on CNBC if they're actually covering this, which they generally are, they're often making comments about what they're currently seeing in the text. Okay, and this is even before the text has actually been read into record. So we end up having these sort of opening remarks. Then the Fed chair is given the floor. The Fed chair then reads the prepared remarks into the record. Once they finish, there then a Q&A session that's going to happen. And each senator or congressional representative is generally given 5 minutes to go back and forth with the Fed chair asking questions. The Fed chair wouldn't know what the questions were in advance. They're doing this in a very unscripted way. So what's going to occur, right, is we can use this in order to measure the emotions. So from the transcript, we're going to get a bunch of text that we can take a look at. From the video, we're going to be able to take the video and extract it into 2 pieces. Part of it that we're going to be able to look at the face. Part of it we're going to be able to analyze the tone of voice that's being used over time. Okay, so when we use the text, we have sort of 2 options, right, that are typically seen in the literature. We can use a dictionary kind of based to get some sort of sentiment out, and we can use language models. We're going to use some of both. The option 2 is going to be the one we're going to rely on the most. But for the first part in the economics literature, there's often these dovish hawkish measures. So Gordonenko and his co-authors in their article on the voice of monetary policy, looking at the tone of voice, they use specific keywords and rules for each sentences to try to get the idea of a dovish or a hawkish monetary policy. So hawks are generally looking at contracting, okay, like increasing interest rates. Doves are the ones that are going to be more expansionary. So they try to use the sentiment on that particular environment. So we're going to adopt their particular measure, but we're going to use it more as a control in our particular purpose. What we're going to do is we're going to try to use one of the sort of state-of-the-art language models. We're going to use BERT in this particular environment. And what we've done is we're going to fine-tune BERT with labels from 2 testimonies that we went through and hand-coded and made sure we had some agreement on it in order to get the sentiment for each of the sentences that were uttered during our testimony. Now, when we looked at this, we also, for people who follow these kinds of things, know that there's like a fin phrase BERT. We tried to do the fin phrase BERT. We found that it wasn't all that accurate for our particular environment. So that's where the AHKZ is the one that we trained after labeling a few of these 3-hour testimonies. And that's the one that we end up finding works a little bit better than even a combination of the fin phrase. Fin phrase was done using sort of statements that were made in the newspaper about annual reports and about those types of statements. So they are not a perfect match or even necessarily a good match for the types of questions that are coming out in the testimony. And in fact, if you use them, you often will get counterintuitive type results. So now what we have to do is we have to get enough sort of text to sort of put things on particular topics and be able to analyze. So we aggregate these things at what we call a block level. For remarks section, because we're not going back and forth, we basically define a block to be 10 sentences. We vary that somewhat, but that's our baseline case. For the Q&A rounds, what we do is we treat one block as one round with one set of questions for each senator or congressional representative. And when we talk about topics to look at things on that level, we do it at the individual level of a Q followed by an A. And the topics are basically conditional, or these groups are conditional on looking at them lasting at least 30 seconds, okay, in order to be able to accurately say we're in the same range as the actual tick-by-tick financial market data that we're looking at. So what we end up doing is we're going to classify the sentiment for each sentence as positive, neutral, and negative. And for our block, what we're basically looking at positive minus negative sentences over the number of sentences divided by our standard deviation. Okay, we do a sentiment measure for both Fed chairs as well as the congressional representatives and the senators. When we do the sample topics, we're using BERT embeddings and the HDBS scan clustering algorithm in order to get things. And it gives us things that are fairly natural. For those of us who are used to looking at monetary policy kind of things, we're going to see topic 0, which, by looking at it, the Dodd-Frank rules and everything, this has to do with the financial stability and oversight of financial markets, the regulations. Topic 3 had a lot to do with housing markets and the issues that came out with Fannie and Freddie Mac. Fannie Mae and Freddie Mac. When we actually look at topics 7 and 8, along with 5, we're talking about liquidity in the market and monetary policy, and then we have fiscal policy showing up as well. Now, when we look at the voice measure, so that's the text is one part. When we look at the voice measure, we're going to basically follow the same kind of approach that was used in the political science literature. We're going to be using Pratt in order to analyze the fundamental frequencies of the voices. In order to get the timing and who is talking at what different time, we basically used a forced alignment algorithm in order to take our transcripts that were done in real time, along with the vocal recording of what was said. We parse these audios to the sentence level. Okay, and then we're going to weight each of the sentence pitch by the time span and look at things where high pitch is associated with active or intensified emotions during this particular time period. So at a block level, again, we're just sort of combining these things to get an overall measure. Again, one created for Fed chairs and the other created for senators and congressional representatives. Okay, we do demean here for the different groups because Janet Yellen will naturally have a higher voice pitch. Women do than what the men are. So, and we do calculate the standard deviations and for different groups. Okay. Now we turn to looking at the facial part. So now yet another set of tools we bring in order to look at this. We use a three-step approach. We use a facial action unit or facial emotions. Here we're using Face Reader as a software that is often used in psychology. We also have some access to others. They look like they give similar types of results, but we're still experimenting with them. What we do is we're going to recognize the faces and the names using the Microsoft Azure Video Indexer. And then we cross-check these using the testimony information and then manually check any kind of inconsistency. We're then going to be able to match the face and the emotion or facial action units to each participant. This is all above board. These are political figures, so there's not a privacy expectation in terms of testifying in front of Congress. Now, Face Reader, you can see here what it does is it's going to map the face. It was trained on a bunch of video that are used in this particular environment to try to get out some basic emotions: happy, sad, angry, scared, and disgusted. Now, when we actually do this, right, Face Reader was designed to really be in the lab. Okay, so when we do this, we are going to best case scenario. They are of a certain distance to the camera, and we're going best case scenario. They're very focused on what the Fed chair is going to be. There are some challenges we had to deal with. Real life situations, you have multiple faces, even though they're front view. Sometimes they turn. Sometimes you have a microphone that is obstructing part of their mouth. But really the combination and why we decided not to use some of the canned packages is sort of twofold for this. First, the training set that's used for face readers and the eye motion and facet emotion software don't have people talking. And in this particular case, they are talking and talking almost consistently. So when your mouth is open, there's a good chance that someone could make a mistake that you were going, as opposed to actually just being mid-sentence in some sort of scenario. Same kind of thing happens if the microphone moves in front of somebody's mouth and it's a big open black area. Again, you could get some erroneous environments. The other thing is, even when we did try to use it and say, well, what would happen if somebody did decide to take the off-the-shelf AI topics and look at it? It's actually going to give you very unintuitive results on this. So what we decided to do was use a different set of their algorithms and training that we found to be more reliable. And that was looking at the facial action units. So again, what the AI is doing is mapping different points on people's faces. And then they're being able to look over time to see whether or not you're opening your mouth or you're raising your eyebrows. And this is the facial action units that we're going to then use to map into a combination of emotion construction data that starts with Ekman, and then Ekman and Friesen actually updated this. So you have ideas for what facial action units are typically associated with happiness, sadness, anger, disgust, etc. Now, these tend to be fairly well defined in many psychology papers. And so we use combinations of the action units. And what we're able to do is basically take out the impact of the mouth, all right? What that's going to do is prevent us from making any mistakes about individuals talking, or nowadays wearing a mask in front of somebody's face, so that we're looking at the points here that are actually most relevant for capturing people being uncomfortable. Okay. Unlike the other paper that tries to look at facial expressions for press conferences, we're going to do this at very high frequency, so 30 seconds 30 frames per second. We're going to analyze them all because micro expressions can happen very quickly. And if you're only taking 1 per minute, you're going to potentially miss things. We're going to basically look at the negative emotions because we're missing the smile component of it. We're going to look more at the eyes and wrinkling your nose. And that's going to be sadness, fear, disgust, and angry. We basically do this for both the chairs again and the Senate representatives, and we're going to create the overall facial measure. We then have to combine this with the tick by tick financial market, which data, which right now I'm going to show you the results that we've got for the S&P 500 and the VIX, which will be expanded in future work. In order to do our alignment on all of this, first we had to generate those time transcripts at the sentence level that I talked about for the audio. And then the facial metrics come in pretty naturally because once you've aligned text and audio, the audio goes along with the facial from the actual video, not a problem. Then the more challenging part is to make sure that we have the tick by tick data lined up. What we do is we actually had permission to get a bunch of information from the CNBC live coverage. So we tried to find time periods where you can hear what the testimony is on screen, and we can see the real-time ticking of the S&P 500. And so we have a fairly good match with the testimony and what's going on in the markets. We then confirm that with official start times and end times and looking at the real-time data on the clocks. So summary statistics, what do we get? We have an equal split for our 32 between Ben Bernanke and Janet Yellen. Okay, Janet tends to have a longer Q&A session than Ben does, but other than that, it's pretty standard. You would typically see if we looked at the ones that are not created to already be 0 at the mean, you will see that Ben Bernanke and his face and his text as generally more negative than Janet. That's not surprising for a lot of economists. They know Ben was dealing with some pretty rough times during a portion of his tenure as Fed chair, but that's what we're actually seeing show up here in our states as well. Now, if you ask about the correlation between the emotion methods, what we would see is in a lot of cases, if they're actually in the remarks section, face and voice are relatively highly correlated. Once we get to the Q&A session, all bets are off. These different things are projecting different types of emotions to individuals who are watching. This is true even whether we're looking at the ones for members or whether or not it's the Q&A for the chair directly. The correlations between the chairs and the members directly, you can see that the facial expressions back and forth between them are highly correlated, but the others are not. So let's talk about the results now and the remaining time that I have before I open the floor to question. So what we're going to do is we're going to use local projections. All right. So what I want to do is I want to regress the change in the outcome. The outcomes here are going to be the log of the price of the S&P 500. We're going to have our text that's going to happen in our blocks, our voices, our faces, our controls are going to be this dovish hawkish sentiment based on the Goronichenko paper. We have testimony fixed effects. And what we're looking for is the parameters of interest. So as we roll the H, we're going to be able to see what the impact is over time. So it's going to give us basically an impulse response. So what we did find is that for the S&P 500 and the VIX, we get fairly intuitive results. What's going to happen is that when the chair voice seems like they're happy or stressing things, they're going to find that the S&P 500 is going up. The text is not particularly significant in this. In part, I'm not surprised because, again, I told you that the text is going to already have been released even before they're actually discussing it on this particular time period. So some of those effects are already going to be masked. The chair's face can also have some impacts here on the S&P 500. The VIX is a little bit confusing, but we'll be dealing with that in a different way. Now, I told you that the remarks were actually done the same in 2 different periods. So that also gives us an alternate way of taking out the impact of the text directly, right? So if it's using the same text on both days, we can kind of use a difference in difference type strategy in order to see whether or not the voice and face, which should be really the only difference between this remarked period that's living, whether it has an impact in the change in outcome that we actually see for the difference between day 1 and day 2 of the testimony. And what we see is this confirms that we find some evidence that both the voice that's being used, or the tone, and the expressions on the face are actually significantly moving the S&P 500 and also having impacts on the VIX, not as much. Now, when we get to the Q&A session, This is the unscripted component of it. We do the same kind of thing, but now we just have a different block, right? Our block is between the senator and the congressional representative and the chair, depending on which one we're talking about, day 1 and day 2. Again, what do we find? Something that's very, that is significant effects for S&P 500 for both the chair voice and the chair face. We see some evidence that the member's voice may have impacts as well, but it seems to be happy, seems to be calming the VIX. Happy seems to be increasing the S&P 500. There are some evidence of some differences between the chairs, whether or not it's Ben or Janet. Seems that Janet is not moving things quite as much with her expressions. Ben seems to have a little bit more of an impact. What is interesting here is that the members and the responses of the members to the Fed chairs do seem to be different and have much more of an impact when dealing with Janet Yellen. Same kind of thing occurs for the VIX. I'm conscious of the time, so I just want to move forward with some of these. We also see that it does matter what kind of topics they're discussing. So we've taken some cuts. Those areas where the Fed has oversight or control over, as well as a sector like housing that ends up being very interest rate sensitive, we do seem to see that there is more of an impact on the markets when we're discussing topics of this size or this environment. So the regression and identification strategy is basically the same kind of local projections that we had before, but again, using the smaller subblocks. So topic 0, which is the one that is basically related to sort of financial stability and financial regulations. You can see, again, the point estimates would suggest the chair's voice and the chair's face are going to be significant in terms of, at times at least, in terms of moving the S&P 500 upwards. For the VIX, again, it's going to be calming during this environment. When we look at this housing market, this is one where actually the magnitudes tend to be larger. The housing market was very related, obviously, to the type of meltdown in the business cycle environment that we saw following the Great Recession. So again, not surprising perhaps when the chair looks confident and comforted by this, that we would actually see movements in the S&P 500. Topics 7 and 8, so this has to do with interest rate, the expectations for inflation, as well as the monetary policy. Combining these topics together, again, we can see that there's impact of the chair's voice on this that would bring the VIX down and the S&P 500 up. When I look at the Fed balance sheet, which is basically liquidity on 5, again, we see evidence that in this case, the Fed chair looking happy about the amount of liquidity, et cetera, in the markets also seems to have impacts over and above and much larger than what we see in the text. Unconventional monetary policy, which are the ones where we had to really blend a lot of the Fed balance sheet, we thought we could take a look at that by combining topics 5 and 8. And again, we see, again, the same type of message coming through. When the Fed is happy, or the Fed chair is very happy about the balance sheet, about the unconventional monetary policy and is confident in that, that tends to help markets in this environment. When we look at fiscal policy, which is something that the Fed cannot control, however, the results are weaker. And in fact, the Fed chairs usually actively try not to make comments on what it is that the congressional representatives should do in terms of the debt ceiling. And that comes out over and over again. So the individuals that seems to have a little bit more of an impact is what it is that the members are actually saying about the debt ceiling as opposed to the Fed chair. The ones that are most confusing, I guess, of the group that we looked at had to do with what to do with labor market and inequality. There's lots of discussion here about the different subgroups and some people doing well and some people doing poorly. So there is some evidence that there may be some movements that come along on this line, but they're not necessarily ones that go along with our standard intuition. So we're going to be diving into that a little bit more. Things that didn't naturally get classified into these other tight groups. When you look at them, they sort of look like sort of general economic conditions when you read through a number of them. And this again is just sort of showing you, even for the general economic conditions, when the Fed is happy, when the Federal Reserve Chair is trying to reassure individuals, it does look like the stock market is going up and the VIX is going down. So trying to keep on time, which I think I'm more or less there. I see 3 6:45 on my clock. A summary of the findings to date, it is ongoing, but it does suggest that text, voice, and facial emotions do have the potential to move financial markets. They don't always work all in the same direction. They do seem to be disjoint from one another in terms of the signals. They're not highly correlated. We see that topic matters, okay, in terms of where we think the movements and the magnitudes of the movements are going to be. And the response may differ from Fed share. So when we're actually going to be adding extra testimonies, we're hoping to be able to separate that a little bit more as well. Now, the congressional members' emotions, we can see also tend to have instances where they can affect markets just as much as the Fed chair can do, especially with respect to certain topics. And we know that the markets are watching things a little bit differently in terms of the remarks in the Q&A sessions. We saw that, and you can clearly see that, for example, on the facial emotion on the VIX. The main thing for the AI stuff that we looked at is using off-the-shelf tools is not something that somebody necessarily wants to do. There's lots of issues about training and everything. Using the tools and retraining them for your particular purpose obviously was very important here due to the fact we could get some very strange results that come out. And when you start diving through, you start realizing, of course, why that would be. Now, the ongoing stuff going forward, we're going to expand the sample to include Greenspan and Powell's testimonies. We're going to be looking at additional investigations into the different chairs when we fill that out, extension of the analysis to other financial variables, addition of other regular testimonies, perhaps looking at a holistic index based on all three emotions. We found some data that we think we can maybe train on that, and also investigate this spillover effect to the transmission to the media, because that's going to amplify any of these issues and echo things through the economy in general. Okay, and there's obviously further refinements of topics and our training on the BERT model. But with that said, I say thank you, and I open the floor to any kind of questions. And as I said, Alexi, Shinfen, and Shu are in the house here with me, at least virtually. So I'll stop there.
Great, thank you, Michelle. So the floor is open for questions. Whoever has a question can raise their hand. Nicola?
So thanks, Michelle. This was super interesting. I really love this stuff. I had two questions, if I may. So one is, and you pointed at this a little bit, about how to tailor these tools to the particular case of central bankers and so on, and the informativeness on the gesture or expressions. And I think the issue is that the biases that we know exist in AI and so on might be particularly exacerbated here. We're talking, the training set, if you want, is middle to, aging white men, and who are English native speaker on top of it. You might have situations, think about the European Central Bank, where the president is from a country, well, at this point with the EU, for sure, not English speaking. And so there is an accent and different cultures and so on, different ages. So I wonder what your thoughts are about how amenable to say something more generalizable this approach is. And then the second question has to do with broadly speaking, the efficient market hypothesis. So there are these movements related to voice and expressions and so on, and topics. Can we say anything about the efficiency of these movements? I'm thinking, what would be the baseline? Should we have like a machine talking with a totally dull voice and a fixed expression and so on? Would this make markets more efficient, avoid, panics or whatever? Or is there an efficiency enhancing role in facial expressions, for example?
Okay, so let me break them up into the two parts, and Jinfen is around, so she may have some comments about the training as well, since her background's very clearly in data science. So what we did find, or at least when I was looking at some of the things, there are some issues where sort of face reader and everything like that, it's not just the tone of voice or the text that you're talking about, even identifying things. So if people have different skin color, I'm easier to identify. I am extremely pale. I put on lipstick and stuff like that, and you're going to be able to very clearly see a number of my facial features. And I probably do pretty well at even trying to find out, the color of your skin, because the flushing and everything shows up much
even
better.
glasses. I mean, they cover my, or anybody's eyebrows, for example. And
well, so but the eyebrows, actually, surprisingly, they were able to catch a lot of that with the eyebrows and the glasses. I mean, if you're
because it comes out,
okay, and above,
enough.
Right? So you're doing a comparison
fair enough.
as to the distances. So we found that the facial expression component, when you're dealing with that, so long as it's got the landmarks right. Okay. And sometimes you can really tell when it's going wrong because of, dimensions, et cetera, that you can kind of test where things are. We were able to get that. Now, in terms of the training for the text, right? I mean, you would probably have to look at when you're dealing with different countries, if there are certain, colloquial expressions or something that are going to come into play, right, that are not sort of US based, obviously there would be some mistakes that are being made there. We do think we need to do some more training. Right now, we're trying to do a lot more on the American component first, and then we can branch out. But I think it's certainly quite doable in these particular environments. And I think there's even some databases that are trying to train embeddings now on all Fed and ECB, et cetera, communications that may be very useful going forward for expansion. In terms of the tone of voice, we're looking at frequencies changing, so a fundamental frequency here. So we didn't try to take the approach where we're going to try to train a model on their particular voice directly on all frequencies on this. So it depends on how you want to think about using your voice, right? Some people and there could be differences between a prepared remark and a Q&A, right? Because some people will use their voice in an effective way when you're planning to, in order to stress certain points. Other people might start getting very hyper when they're under stress, and their voice may start creeping up. So there's issues to be done with that. In terms of efficiency, I think I'd like to sort of phrase this in a slightly different way. Is it going to be better if a robot gives a report? I'm not sure that's true. But what I do think is true is that for the central bankers, for the individuals who are actually thinking about communication, that understanding the way that certain things may be perceived, okay, could be important, that there could be miscommunication, that not everything is going at the same time. So I showed you, for example, we found that in the remarks section, right, face and voice and stuff are much more aligned. That's stuff we can practice. When we get into all of the other types of questioning, we break that component. And so you're getting different kinds of signals that are really showing up here. So I think it probably would be more efficient if the signals that are being sent, right, are sort of accurate in that way. And when we get into crisis mode, so I'm sure Nicola probably watched this, I certainly did, when, example, Tim Geithner came out with his first statements about in the middle of the crisis, don't worry, we have a plan. And his voice was elevated and his facial expressions looked like he was really shaky, and the markets didn't believe him at all. And we went into free fall. Words and emotions just did not go right. What you may want to do is, in times where there is extreme crisis, right, make sure that the person's delivering the messages look calmer. Make sure, like, maybe there's a selection as to who you want to deliver the bad news, right? But I do think that there's obviously work on that can help improve the communication and therefore help with the efficient responses. Should a robot deliver the news? Nah, I don't think we're quite to that yet. I actually think that there is benefit to obviously seeing, and there has been work, obviously, I think in the finance literature that says that sometimes these micro expressions or the tone of voice does deliver information when you're not telling the truth, right? And so there could be signals in there that could help if you're really at odds, if you understand why that's occurring.
And you might have the risk of the medium being the message, in a sense. So if you bring a robot, it's there is bad news, just for the fact of bringing the robot, just to put it at the extreme. So there is also this additional level.
I agree with that. I mean, and also if there are any kind of biases with the robot trying to train to get the message, I mean, we would just amplify this, which is why I'm saying we might be seeing what automated traders are already trying to incorporate into some of these for the time period that we have. As we go back further in time and have enough to sort of split it, we'll be able to see a little bit more about what may be traders versus the algorithmic group.
Thank you.
Thanks for the question.
Great. Peter?
Thanks very much, Michelle. It's a really interesting project. I wanted to, and it's nice to see political science work getting picked up by economists and cited. Gets picked up all the time, doesn't get cited. The main thing I want to ask you about is the following, and I apologize, I had to miss 10 minutes in the middle of the talk, so I probably missed this, but I'm just wondering how we think about the theoretically one thing and then empirically one thing. What I'm just thinking about theoretically is the fact that this is a highly strategic environment in which pretty sophisticated actors are talking to each other. They have expectations about what each other is going to say, and then they are speaking against those expectations, in the sense that, you know, if you watched Tiff Macklem today, you know, there was an expectation about what the governor would say, and there was what the governor said, and it's the conditionality that actually matters here, right? So I'm trying to understand how that's picked up in what we're looking at here, because this is a really highly constrained communication environment, right?
It is.
It's also constrained. So just two things. It's also constrained in the sense that the amount of room to maneuver, like actual room to maneuver for the actor that's there, is very limited, right? In terms of the range of things that they could be talking about, right? And the amount of, it's more than just how many basis points will go up and down, but it's not much more compared to a federal budget, for example, right? Or compared to the reasoning behind a legal decision as it happens, right? So I wonder how we account for that. And then the third question, which is the empirical one, which is really uncharitable, is that if I just look at the data and I look at the width of those confidence intervals, I notice two things. One is that I notice that most of it's just straddling around zero. And if I was thinking about this, honestly, in a multiple testing perspective, I would say you've put up X number of graphs, and if I do a bond friendly correction, I honestly don't see anything here in terms of actually moving the markets, right? I see noise, really. So I just wonder how we could talk about that. And then there's a feature of these confidence intervals, which is that they keep getting wider. The effects keep getting less certain as you move along in time. What does that tell us about what's going on?
All right, so let me try to go through a bunch of these, and I'll also invite Shu to comment on the confidence intervals and everything. So one thing I'll say just about the confidence intervals, there are times where this is a 10% standard error. We only have 32 of the testimonies in there right now. When we put in more data, those will likely start shrinking on a component of this, right? And one of the reasons for the testimonies, we have a lot more data. So if there is something there, we're going to start being able to uncover this. There are already times where we can see at a 10% confidence interval, it's there. Now, in some of the other work that's done in the era, they didn't even find any effect on the day. They found it magnified as it's picking up through the media on the days after the FOMC press conferences and everything like that. And so even though we might see small impacts right now, while we start doing the analysis of the spillover onto the media, if it follows the same pattern as at the FOMC press conferences, these effects will tend to get larger and more significant for the days following this particular movement. So I'm not quite as concerned as you as saying, well, there's just complete noise there. I think that there may actually be a little bit more there than you think, I guess, at the time. Now, in terms of constrained actors. So, I mean, the Fed chair has some room to manipulate the discussion. In future rounds, we've actually collected a lot of the information now as to who's doing the questioning, where they're from, what background is, whether or not this is a Democratic senator, talking to a nominee that was a Republican nominee, to try to see if we can tease out a lot more on those dimensions too, to find out, how these actors are going. The congressional representatives and the senators are probably playing a little bit more to the press in a number of these things. So their facial expressions tend to be a little bit more exaggerated, I think, at some times. What's happening with the Fed chair, however, is I'm not sure how much they're playing, right? In the Q&A session, especially, they don't know what's coming to them. They can't really plan for a really good strategy. They can try to sort of think about the kinds of questions that they have, but when they're actually in the hot seat and they're sort of micro management of sort of surprise or not, these micro expressions, I think, still probably the most seasoned people have trouble sometimes suppressing what that's going to be. That's sometimes an innate response that's, you know, based on physiological responses to stress. So I guess we could debate about that. Your second question, I'm trying to remember what your second question was. Sorry, you asked so many of them, and I was like,
sorry, I think they were kind of no, that's fine. I mean, basically it was two. One was they weren't well put. I guess one was about the confidence intervals, and the second is just about how we think about the modeling here, about what people expect to be happening versus what's being said, and kind of, I guess, where emotions sort of fit into that.
Right. So I do think that that's one of the reasons too that we like the idea of the testimony. There is some part that's very scripted, some part that's going to be very, very rehearsed. And then there's the component that goes back and forth in which the Fed chair is really taking questions that they don't know what was necessarily coming at them. And, you know, sort of the back and forth on that. Sometimes you can see them getting visibly upset. Sometimes there are just really wild discussions that happen, like Ron Paul and Ben Bernanke have some real interesting ones that are completely off topic from monetary policy, and you can really see how that goes. We're also going to be going forward trying to break this up a little bit in terms of initial questions and sort of the follow-up to try to get a lot more on terms of the discourse and again, try to do more correction on that, to mention, as I said, this sort of work in progress in that. But from a political side, I'm more than happy to have conversations with you, Peter, as to suggestions as to other corrections or controls that we might put in there in order to sort of suck up some of the other variation that could come from those congressional representatives. I mean, right now we're treating a lot of them sort of as almost like a representative. And I think there's a lot more to be done in breaking those apart.
Yeah. Thank you.
Great. I think we had a question from Bob, but I don't see him anymore. So we should move on to Avery.
Thanks. What a thought-provoking presentation. Thank you so much. I wanted to ask you about the work of Paul Ekman. You mentioned Paul Ekman's work in passing and his sort of the facial action coding system, et cetera, right? His body of work there. And I know his work as linked to, he was especially interested in tracking deception. Yes. And some of the facial action coding system is still used in like eye border control. So trying to look for micro expressions that indicate one thing is being said, but another thing is being meant or suppressed or whatever, right? And so when I was thinking about the uses of some of this research, I was wondering if I heard you making a case for this kind of verbal communication produces this kind of belief about what that macro, perhaps, level of verbal communication and nonverbal communication indicates, and then the markets react accordingly. But I was also wondering if there's a little bit of, well, but we could also make an AI to read Yellen, for example, better than we ourselves can read Yellen. And then we'll know what Yellen really means. I mean, is there also a level here of looking for micro expressions? Is that one of the ultimate uses of this kind of a project? Or is that something you actually want to stay away from? Just curious about deception here. Yeah.
You know, it's hard to know about the deception. So I did have a conversation before I even ventured into this with any of the people at the Bank of Canada. In terms of deception, I mean, I think there's part of it. I was wondering about deception initially as to whether or not, not so much deception, but whether or not you could capture something that the Federal Reserve Chair is aware of, but it's not in public information yet, and you're being asked about it, and they're sort of hesitating. So it's not that they're actively trying to deceive you, but they can't really answer your question because maybe they saw something that was sensitive. Now, I asked Ben one time when we were at lunch together, and I said, how much information do you actually have that we don't know by the time you actually have to do this? And he said, there's actually not that much at the end of the day in terms of, I mean, maybe, like releases, official releases of things and everything before, because sometimes comes to me a little bit before it would be publicly released that would have to be done. But when you're doing a lot of these testimonies, I mean, the things that they would have seen that may not be fully publicly available would be the staff reports or projections that were going on. we haven't taken a hard stand on what it was we were trying to do here. And it's not even clear, right? Just, you could find a significant response. It may be unusual, and you don't know what that means. Like, what is it that, you know, people are actually interpreting, right? Just because we labeled it as surprise, or we labeled it, like you said, there's different ways that, and even different cultures may take a look at the same kind of micro expression and have a different response to it. I'm not a psychologist. This was just me sort of reading some of the psychology things as we sort of dug in and realized we got some very strange results coming from the sort of off the shelf. But then when people aren't talking, or sorry, it's not trained on people talking and stuff, there's a lot of noise that could come from that. So we're at least pleased to see that when you actually looked at things that had been documented, that had been tried and truly determined in the lab, at least that in real life, it did look like at least people were picking up on these expressions. What they were making of them, you know, that's sort of a testable hypothesis as to whether it bothers people or not. But I like the deception is not just what I wouldn't quite call it deception in this particular environment, as opposed to, you know, maybe inability to make a full statement or a full comment on this. Like, even in terms of, you know, picking up what a Fed chair might think of congressional policy. They're actively telling you, I can't say anything about it, but I guess if they kind of look like, I really can't tell you anything about, you know, like, so you could maybe glean a little bit as to what's going on, but yeah.
That's when you need to bring out the robot.
The robot,
the message robot.
Is what it's like. I am not saying
okay.
right on this particular environment. Okay. So I do think that there's still a lot of work to be done here, and even maybe some additional training on some of these other kind of models might help. But I think it has to be trained in an appropriate way with people talking with extra inputs out, because right now the stuff that's done from the lab to the real world is still, I think, problematic in certain dimensions.
Jillian has a question, I see.
Yeah, so I was partly joking, saying bring out the robot, but maybe not, because you know, and maybe this also what Peter's getting at. There is just so much noise about the relationship between people's expressions, tone of voice, and real information. Like sometimes it's going to be like you just gave the example. I can't tell you. Like there really is something back there. And other times it's, you know, I mean, it makes as somebody who sort of gives talks is like, you know, or as a professor, right? You know, it's sort of like, oh God, like my students really shouldn't be paying attention to what's happening to my eyebrows, because, you know, it's just not really all that relevant and it's distracting to them. And you get comments, right, on your there was once a skit at U of T Law Follies about, you know, watch your eyebrows, like that's going to be the clue. And I really actually pedagogically want them to stop paying attention to that stuff. And I certainly am not trying to give any messages. And I'm sort of wondering, it's sort of like now fold this into, okay, you're using AI to study this. You know, are the high frequency traders trading their algorithms on this as well? And so have we just sort of layered on top, like, you know, even more trading that's based on noise and predictions about how people are going to respond to actually irrelevant information, like, you know, a hiccup, an eyebrow, a squint, a micro expression that flies across. We're going to make things worse. I mean, high frequency trading, right? Like we pour all this stuff in. It's not actually producing economic value, I think.
So I think I'm gonna hit it on two different dimensions here. Okay, so like I said, we're starting here first in our investigation at looking at sort of the high frequency trades. The next portion of this, which we're actively working on in terms of the news, is sort of the real-time news and whether or not even some of these micro expressions frame the discussion of what comes out. Okay, that may be important. And if a robot gave it to you, I mean, if you're trying to make a point or underscore something, a robot in a monotone voice with no expressions and stuff like that, it's not clear whether or not it's going to necessarily help, as opposed to help inform us in terms of going forward, what kind of effective communication you want to do in terms of accentuate the positive and maybe not the negative in certain areas. So I do think that it's a slippery slope, right? Could you cause a lot of noise if it was only algorithmic traders? It is possible. right? I'm not going to dispute that it is. Hopefully, we can get a hold of some data that might be able to tell us in certain time periods whether or not these are sort of institutional traders or whether or not these are the, the retail traders who are potentially being impacted by some of these things, but their attention span is going to be different, right? So it's going to be a hard thing to, I think, disentangle fully. But I think that the media people in the central banks would like to know if there's something they're doing, like I'm raising my eyebrows, but I don't really need to be raising my eyebrows. But every time I raise my eyebrows, people get the wrong message, right? That you could at least be aware of that and try to stop the miscommunication that goes along with this. I don't know if any of my colleagues at the bank want to comment on that. They're here somewhere, I think.
Hiding behind cameras. Yeah, I guess even thinking about that media training, just also, sort of like, oh my gosh, like, now it's layers upon layers of trying to be inauthentic, to control all of that and, say this, don't use that word. I just feel like we're drifting from something. It makes me also think about, the symphonies that decided they had to put auditioning players behind a screen so that, because actually less information was better for making decisions. Anyway, I'll leave it there, and maybe one of your colleagues has got something to add in here. It'd be good to hear.
I don't know if Alexi turned on his camera, so.
Yeah, I can jump in. These are excellent questions and difficult questions. Just to bring a little bit of context, the Fed and central banks have been steadily moving towards increasing transparency of their communications, right, over decades. Maybe, we're talking about robots. The closest example is probably Greenspan, famously, right? So he'd probably get you the closest to the idea of really kind of unemotional delivery during these kinds of events. But the context is that the central banks have been trying to improve the transparency of their delivery. And one example why they wanted to do it is exactly what Michelle said. Credibility of the central bank matters in an environment when markets or general public do not know everything about the economy, and they do not fully understand how monetary policy works or how it improves welfare of citizens. And so they would look into, for events like this to get additional understanding of what's going to happen. And they look to a leader who is delivering that message to answer, their concerns or to explain what's going on with the economy and how the central bank is going to help the economy do well. And so for that, for the event of delivery, our research is looking into part of it, which is the softer side of information, not only what they say, but kind of how they say it. And our preliminary results show that that part seems to matter when measured by how financial markets react. It seems that financial markets do react. So that's kind of one additional answer I wanted to bring here.
I think Nina has a question.
Hi, so Michelle, thanks for a wonderfully fascinating presentation. So I noticed that some of the, from what I recall, the emotions that you had coded there, sorry, my kids are making noise, were sadness and fear and anger and disgust. So I do some research in moral emotions. And so anger and disgust are two of the kind of triad of outward facing moral emotions. So I just thought it was kind of curious, other than the third one is contempt, that I wonder, like, do you think there's some kind of underlying mechanism of, I don't know if people would read it as morality, but sort of like the expressions of saying, like, anger and disgust, like I'm delivering this message, but I'm really unhappy about the fact that I have to deliver it. Like, I find this as like morally, unjust or anything like that. Do you think that they're?
So, I mean, I think this, I think in different topics, it may be, related to different responses that they're talking about. As I said, the one I found that was most unusual to try to talk around, and we have to dig into this more because these are still preliminary results, as I was mentioning, is the ones where they're really talking about inequality and labor markets and stuff like that. And there's some weird responses there. Like there are facial expressions that go on. There's probably impassioned pleas going on as they're talking about problems in minority communities and the fact that they're being left behind in some of these things. That's the one that, at least when we looked at the impulse response functions as estimated, they were a little bit more all over the place, and it was harder to determine. So how they're actually interpreting these questions or the tone of those questions might be something to sort of try to unpack even by itself. In terms of some of these other ones, sometimes they get angry because they're being, the two different groups who are talking to one another are really coming at it from different sides. And so, Janet Yellen, for example, gets cut off a lot, on some of these cases. In fact, one of them on CNBC, you can clearly see the announcements go, boy, this poor woman's getting cut off all over the place. And you can see she's getting frustrated, right, on a bunch of these things. So, depending on sort of like the discuss, it could be sort of the general interaction. It could be related to the topics at hand. And I think we need to do a lot more digging on that particular way. I mean, if you have some interesting examples that you think we should sort of dig into now that we've sort of got some ideas about what they're describing. I mean, overall, the debt ceiling, I'm not sure that's a huge moral issue on those. So some of these things, I don't think there's an aspect of sort of real morality. Issues of inequality, there I think you're starting to touch on things where, people's beliefs and how you weight different groups in the economy may come into play a lot more.
Yeah, I just thought it was really interesting, and it sort of just jumped out at me automatically. And I was like, oh, that's right, because for us, it's just such a strong moral component, and the fact that you're seeing those, and then maybe seeing how people are responding differently to the links with like sort of a.
Yeah, so it might be interesting to see where those ones are where those facial expressions are really hitting the most in terms of ours, especially the discussed one. And seeing what kind of topics those are most related to. That might at least give us a first pass on that. I thank you for the question. So Jillian said, would be interesting to experiment with human capacity to discern. Yeah, I mean, I think experiments are fun. I've never done one myself and had to go through the ethics approval to do it, but I certainly do think that, figuring out why people are individuals sitting in a room that you can actually ask, are they actually reading these things the way we think they're reading them, right? So, I mean, I think there's some literature in the psychology one too, is like, well, what were you thinking and what did people actually anticipate for like some sort of a discourse? And it's not clear that the AI is fully getting the message right on some of these things. If I could convince Tiff Macklem to give me some time where I could actually code, you just said a whole bunch of these things in your press conference. Now, what were you thinking while you did it? And what it was done and what we actually picked up, that would be an interesting thing to do. I'm not sure I'd ever get Tiff to fully approve that, but I could try.
Great, thank you so much. Do we have any last minute questions? No, I think we don't. Then thank you so much, Michelle. This was really great. Please join us next week for a talk by our very own faculty fellow, Ishtiaq Ahmed, on whose intelligence, whose ethics, ethical pluralism, and decolonizing AI. I look forward to seeing you all next Wednesday.